Hi there, it's Friday the 30th of November 2018. I'm Steve Towers. Welcome to ITB. Let's get started. Well, it looks like the EU's digital services tax proposal will not be approved in next Tuesday's ECOFIN meeting, even though Austria, in the EU presidency role, prepared a fresh proposal late last week, which includes a further deferral of the start of the tax to the 1st of January 2022. By this week, it looked clear that there will be unmovable opposition from several countries, notably Ireland, Denmark, Sweden, Finland, and significantly, Germany. Germany wants to avoid antagonising the US, which might retaliate with tariff increases. And Germany also wants to advance its own proposed solution for digital taxation, the Globe proposal for a global minimum tax. The three ideas or solutions which the OECD has identified, digital taxation based on user participation, a broad-based expansion of market countries' tax rights, and global minimum tax, will be considered by the Task Force on the Digital Economy at their meeting next Tuesday and Wednesday. However, if, as expected, ECOFIN fails to approve the EU DST next week, the risk is that several EU members will introduce such a tax on a unilateral basis. The UK, Spain, and Italy have already taken steps to introduce a similar type of tax, and there must be a strong chance that France will also do so. The US Treasury and IRS have released two sets of proposed regulations in regard to the US tax reform legislation. The first on the new earnings stripping rules in Section 163J, and the second on foreign tax credits. Effective for tax years beginning on or after the 1st of January 2018, Section 163J generally limits the business interest expense deduction to the sum of business interest income, 30% of adjusted taxable income, and floor plan financing interest. Adjusted taxable income is similar to tax EBITDA, as discussed in the final report on BEPS Action 4. From an international perspective, there are two important points to note about the new rules. Firstly, the new rules extend to foreign corporations which derive US effectively connected income. And secondly, the new rules also apply to CFCs in regard to the calculation of either Subpart F income or GILTI. However, for that purpose, an election is available to deal with the situation where loans are made within a group of CFCs. This is intended to deal with the scenario where interest deductions are limited to the borrower, but there's a full inclusion of the interest income for the lender. The document containing the proposed regs is 439 pages, and it doesn't have an index. So I've created this index for you. This shows each subsection in Section 163J, its topic, the pages for the proposed regulation, and the pages on which the Treasury and IRS have provided an explanation of the provision. There are 11 subsections in Section 163J. Here are the first four. Here's the next tranche of provisions, -5 to -7. Please hit the pause button if you'd like to study the list. And here's the next tranche, Dash 8 and Dash 9. And the final tranche of provisions, Dash 10 and Dash 11. For a copy of the proposed regs document and a Q&A document issued by the IRS, please go to our website or app. A related development in regard to Section 163J is that the Treasury and IRS have released a revenue procedure concerning a safe harbour for certain infrastructure trades or businesses. For a copy of this revenue procedure, please go to our website or app. The second set of proposed regulations released by the US Treasury and IRS concerns foreign tax credits. The IRS released a statement which explains the background to these proposed regs. The US tax reform legislation made major changes to the way the US taxes foreign activities. Significant new provisions include a dividends received deduction for dividends from foreign subsidiaries and the addition of GILTI rules, which subject to current US taxation certain foreign earnings that would have been deferred under previous law. The US tax reform legislation also modified the foreign tax credit rules in several important ways to reflect the new international tax rules. These changes include repeal of rules for computing deemed paid foreign tax credits on dividends on the basis of foreign subsidiaries' cumulative pools of earnings and foreign taxes, and the addition of two separate foreign tax credit limitation categories for foreign branch income and amounts includable under the new GILTI provisions. The US tax reform legislation also modified how taxable income is calculated for the foreign tax credit limitation by disregarding certain expenses related to income eligible for the dividends received deduction and repealing the use of the fair market value method for allocating interest expense. The new foreign tax credit rules apply to 2018 and future years. The major issue in the proposed regs is the allocation of expenses to the GILTI basket. Such an allocation will generally cause a reduction in the available foreign tax credit for GILTI. Yes, the proposed regs do require such an allocation, but there is some concessionary treatment. Specifically, the Section 250 deduction for GILTI inclusions is deemed to be exempt income, and the shares of the CFCs which derive the GILTI income are deemed to be partially exempt assets. Both of these deemed situations will reduce the expenses which are allocated and apportioned to GILTI. The document containing the proposed regs is 312 pages, and yes, you guessed it, it doesn't have an index. So I've also created an index for these proposed regs. And due to the structure of the government's document, my index is in two parts. First, the government's explanation, and then the actual provisions. Let's start with the explanation. Here's the first tranche of topics. Please hit the pause button to study the list. And here's the second tranche of topics in the explanation. And the third and final tranche. And now the index for the actual provisions. Here's the first tranche, covering sections 78, 861, 901 and 904. And here's the second tranche, covering sections 952, 954, 960 and 965. For a copy of the proposed regs document, please go to our website or app. Well, Israel is in the hot seat. The Global Forum on Transparency and Exchange of Information for Tax Purposes, which has 154 members, has issued its 2018 report. The report shows that the automatic exchange of financial information is working very well. In 2018, there were 4,500 bilateral exchanges between 86 jurisdictions. However, the report also shows that 2 OECD members, Israel and Turkey, are not yet compliant. Israel is the less compliant of the two, and it has been singled out by the OECD this week in public commentary. According to the OECD, Israel has failed so far to put in place the domestic and international legal framework to enable exchanges to take place. It had previously committed to do so and to have commenced the exchanges by the end of 2018. Also, according to the OECD, Israel runs the risk of being blacklisted by the G20. Apparently, the reason for Israel's delay is a domestic political dispute concerning charitable loan societies, which are suspected of being used for money laundering purposes. For a copy of the Global Forum's 2018 report, please go to our website or app. In Australia, the tax authorities have issued draft guidance in regard to the transfer pricing issues related to inbound distribution arrangements. The draft guidance continues the risk assessment approach, which has characterised Australian TP guidance in recent years. Accordingly, if an inbound distributor is classed as low risk, the draft guidance says that you can expect that we will generally not apply compliance resources to review the transfer pricing outcomes of your arrangements. For the purposes of the risk assessment, the draft guidance considers the operating margin, EBIT as a percentage of sales, as well as activities which incrementally generate value. For general distributors, an operating margin below 2.1% is considered to be high risk. Medium risk is an operating margin between 2.1% and 5.3%, and above 5.3% is viewed as low risk. The percentages are different for distributors in 3 specific sectors: life science, information and communication technology, and motor vehicles. The tax authorities have asked for comments on the draft guidance by the 21st of December. For a copy of the draft guidance, please go to our website or app. Also in Australia, the Federal Court has decided a case in regard to Australia's foreign tax credit system. The case concerns an individual, and although I'm usually strictly corporate, it does have an interesting twist. The taxpayer is an Australian resident individual who derived capital gains on the sale of investments in the US. As the investments were covered by the FIRPTA rules, the taxpayer paid US tax on the gains. The US tax was at a concessional rate, 15%, which was lower than the rate which applies to ordinary income. Australia also imposed tax on the gains. However, instead of using a lower rate, Australia provided a concession in the form of a 50% exclusion. 50% of the gain was excluded from taxable income. The taxpayer claimed a foreign tax credit for the full US tax he paid. The Federal Court, however, agreed with the tax authorities that due to the 50% exclusion, the taxpayer was entitled to claim a credit for only 50% of the US tax he paid. From a policy viewpoint, that decision strikes me as strange. If Australia provided its concession in the form of a lower tax rate on capital gains instead of a 50% exclusion, there would not have been any doubt that the full amount of US tax was creditable. If you would like to obtain a copy of this case, you can do so at our website or app. In China, the government has issued Notice 108 of 2018, which provides for an exemption from both corporate income tax and VAT for interest income derived by foreign institutional investors from Chinese domestic bond market investments. The exemption period will run for 3 years from the 7th of November 2018. For a copy of the notice, please go to our website or app. In India, an authority for advance ruling has issued a decision that certain back-office services provided by an Indian company to a foreign company with no establishment in India are not zero-rated for GST purposes, but instead are subject to 18% GST. As you can imagine, the decision is causing some real concern in the Indian back-office support sector. However, there were special facts in this case. The Indian service company provided various back-office services to a Hong Kong trader of chemicals and other products. The back-office services include liaising with buyers of those products. In other words, companies which buy the chemicals and other products from the Hong Kong trader. The AAR held that the Indian service company's actions caused it to satisfy the definition of intermediary in the GST legislation. A broker, an agent, or any other person, by whatever name called, who arranges or facilitates the supply of goods or services or both between two or more persons, but does not include a person who supplies such goods or services or both on his own account. And being an intermediary, the place of supply of its services is its location, that is, India. And accordingly, the zero rating treatment for an export of services does not apply. If you would like to obtain a copy of this decision, please go to our website or app. And in Vietnam, commentators have suggested that the government will revise the earnings stripping rule in Decree 20 to ensure that it applies only to foreign invested enterprises. Decree 20 was issued in 2017. Amongst other things, it provides for a cap on interest deductions set at 20% of EBITDA. As currently drafted, Decree 20 applies to both foreign invested enterprises and Vietnamese-owned enterprises. So far, there has been no official statement from the government on this issue. The European Court of Justice has decided a case in regard to the imposition of French dividend withholding tax on dividends paid to a loss-making Belgian company. The Belgian company argued that the dividend withholding tax breaches the EU's free movement of capital. For that purpose, it compared its situation with a hypothetical loss-making French company, French Code 2 in the diagram, which receives dividends from another French company. The Belgian company's argument was stated by the court in this way. Whereas the dividends paid to a non-resident company are subject to immediate and definitive taxation, the tax imposed on dividends paid to a resident company depends on whether the latter's financial year is net loss-making or net profit-making. Thus, where losses are made, the taxation of those dividends is not only deferred to a subsequent profit-making year, thus procuring a cash flow advantage for the resident company, but is also thereby uncertain, since that tax will not be levied if the resident company ceases trading before becoming profitable. And the court accepted that argument. It held that the imposition of dividend withholding tax on the loss-making Belgian company is a breach of the free movement of capital. The court then considered whether that restriction is justified. It concluded that it is not. In reaching that view, the court decided that resident and non-resident companies in receipt of French dividends are in a comparable situation. A balanced allocation of taxing rights between member states does not justify the restriction, and ensuring the effective collection of tax also does not justify the restriction. For a copy of this decision, please go to our website or app. And now to Germany. In last week's ITB, I told you that Germany's lower house of parliament has passed amending legislation in regard to the change of ownership rules and a secondary VAT liability on online marketplace operators. Well, it's now been passed by the upper house as well. Also in Germany, the Federal Tax Court has decided a case in regard to a downstream merger of a German company with foreign shareholders. The starting structure is shown on the left. A US company owned all the shares in a German company, and that German company owned all the shares in a Luxembourg company. The German company was merged downstream into the Luxembourg company. As a consequence, the shares in the Luxembourg company were transferred to the US company, resulting in the structure shown on the right. The court held that the downstream merger triggers a taxable capital gain for the German company. In Greece, the government has presented its 2019 budget to Parliament. Two items are particularly interesting. The current corporate income tax rate of 29% will be gradually reduced over the next 4 years to 25%. And the dividend withholding tax rate will be reduced from 15% to 10%, although it is not clear whether the reduction will be effective in 2019 or 2020. In Hungary, the parliament has passed legislation which implements parts of the ATAD rules. In addition, the legislation introduces group taxation for corporate income tax purposes, which will enable tax losses and taxable profits to offset each other within a group of companies. The group taxation rule will be effective from the 1st of January 2019, provided a group taxation registration is made by the 15th of January 2019. In Ireland, the government has published a competent authority agreement with Malta, which is designed to stop the so-called single malt structure. The Competent Authority Agreement gives this background. Section 23A of Ireland's Taxes Consolidation Act 1997 provides that companies which are incorporated in Ireland will be treated as resident in Ireland for tax purposes. However, where such Irish incorporated companies are regarded for the purposes of a double taxation convention to be resident in a country other than Ireland and not resident in Ireland, they will also be treated as not resident in Ireland for any other tax purposes, in addition to the purposes of the double taxation convention concerned. Where a company is managed and controlled in Malta, it will be treated as resident in Malta for Maltese tax purposes, irrespective of whether it is incorporated or domiciled in Malta. Maltese tax law also provides that where a company which is resident in Malta but not incorporated and therefore not domiciled in Malta is in receipt of income that is not received in Malta, such income will not be subject to tax in Malta. In summary, where payments are made by an Irish resident company to an Irish incorporated company which is managed and controlled in Malta, and such payments are not received in Malta, double non-taxation could arise. The payments will be tax deductible in Ireland, but will not be subject to tax in Malta as they are not received in Malta. The actual agreement between the two competent authorities is interesting. It is based on the new preamble, which will apply to the Ireland-Malta Treaty when the MLI enters into effect for that treaty. The agreement is that the corporate residence tiebreaker rule in Article 4.3 of the treaty will not then operate in regard to such a company due to the force of the new preamble. For a copy of the documents released by the Irish government, including the text of the Competent Authority Agreement, please go to our website or app. In the Netherlands, the State Secretary of Finance has released a letter sent to Parliament advising of significant changes to the country's tax ruling practice in regard to rulings with an international character. The proposed changes will be effective from the 1st of July 2019. The changes focus on three topics: transparency, process, and content. Firstly, in regard to transparency, the government will publish an anonymised summary of every international ruling immediately after issue. Also, the annual report of the Dutch tax authorities will cover the international ruling practice. Secondly, in regard to process, all international rulings will be handled by one central team at the Dutch tax authorities. Currently, this centralised approach is used for only certain types of ruling. And thirdly, in regard to content, there are several changes. There will be a purpose test. No ruling will be issued if the sole purpose of the arrangement is to reduce Dutch or foreign taxes. Also, no ruling will be issued if the arrangement involves entities in non-cooperative jurisdictions, according to the EU's blacklist, or in a low-tax jurisdiction, a statutory corporate income tax rate below 9%. And importantly, the arrangement must satisfy a new economic nexus condition instead of the current substance condition. The new economic nexus condition has a number of requirements. The Dutch entity must perform commercial operations, which must be for its own account and risk. Those activities must be performed in the Netherlands by an appropriate number of employees, and the entity's operating costs must be appropriate, having regard to its commercial operations. Importantly, the economic nexus condition will apply on a per-activity basis. This means that if an activity is added to a Dutch operating entity, the activity itself will be the focus of the economic nexus condition. The letter gives 4 examples of arrangements which will not qualify for a ruling. An inbound interest-free loan, which generates an interest deduction in the Netherlands under the informal capital doctrine, but which is not taxed in another country. An operating entity which also acts as an interest or royalties conduit, where the economic nexus condition is not satisfied in regard to the conduit activity. A multinational with a large finance function outside the Netherlands and 2 finance employees in the Netherlands as part of a conduit activity. And a holding company with no management activities in regard to its subsidiaries. 2 final points to note. Firstly, the maximum term for new rulings will be 5 years, with the possibility of an extension to 10 years in exceptional circumstances, and only after a review at the end of 5 years. And secondly, the letter should have no impact on existing rulings. For a copy of the letter, please go to our website or app. In the Democratic Republic of the Congo, the government has introduced into Parliament the 2019 Finance Bill. The most interesting item is the proposed reduction in the corporate income tax rate from 35% to 30%, effective the 1st of January 2019. In Egypt, the government has stated that the calculation of banks' taxable profits from Egyptian treasury bonds will be amended to bring it into line with international accounting standards. Commentators have said that this will cause an increase in banks' effective tax rates. The share prices for Egyptian banks have been on a roller coaster ride in the last week due to this announcement. In South Africa, the government has introduced into Parliament a bill to impose the long-awaited carbon tax. The bill, if enacted, will be effective the 1st of June 2019. For a copy of the bill, please go to our website or app. And in Zimbabwe, the government has presented its 2019 budget. 2 items caught my eye. Firstly, there will be a deemed Zimbabwe source for payments made by a Zimbabwe resident to a non-resident for satellite broadcasting services or for e-commerce transactions. If the non-resident receives such payments in excess of an annual threshold amount, the non-resident will be required to register with the Zimbabwe tax authorities. This deemed source rule will be effective the 1st of January 2019. Although not stated, presumably this rule will be subject to a treaty exemption which is available to the non-resident. And secondly, in regard to VAT, inbound services will be subject to a VAT reverse charge in the situation where the Zimbabwe payer is not entitled to an input tax credit for the VAT. Thus, the VAT will be an additional cost for the payer. This change is effective the 1st of January 2019. In Brazil, the government has published a decree which sets out the specific requirements under the Rota 2030 tax incentive program for the motor vehicle industry. There are 3 main tax incentives available under the program. An additional corporate income tax deduction for R&D expenditure incurred in Brazil, effective the 1st of January 2019. An exemption from customs duty on the import of certain motor vehicle parts and components, also effective the 1st of January 2019. And a reduction in the excise tax on motor vehicles which satisfy energy efficiency and other conditions, effective 2022. For a copy of the decree, please go to our website or app. And also in Brazil, the government has released a new instruction in regard to the MAP process. For a copy of the new instruction, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed, 1 protocol signed, 1 treaty enter into force, and 1 protocol enter into force. Well, that's the way it is this Friday, the 30th of November 2018. I'm Steve Towers. Have a great weekend.